What if I told you that while others are juggling 15 plus ETFs and losing sleep over rebalancing, millionaire investors are quietly building wealth with just 2 simple funds? I know it sounds too good to be true, but today I'm revealing the exact 2 ETF strategies that have created more millionaires than any complex portfolio ever could. By the end of this video, you'll have 3 proven combinations that could transform your financial future. And here's the kicker: each one uses only 2 funds. So stick around, because what I'm about to share could be the difference between retiring comfortable and retiring wealthy. Let me tell you about Sarah. 5 years ago, she was like most investors, overwhelmed and overcomplicating everything. She had 18 different ETFs spread across her portfolio, spending hours every weekend researching new funds, rebalancing allocations, and second-guessing every decision she made. She was constantly worried about whether she had the right international exposure, the perfect sector balance, and if she was missing out on the next big thing. Sound familiar? But then Sarah discovered what the ultra-wealthy already knew, and it changed everything. She simplified her entire portfolio down to just 2 ETFs, and not only did her stress disappear, but her returns actually improved. The truth is, complexity doesn't create wealth, it destroys it. While you're busy analyzing your 15th ETF option, successful investors are watching their simple portfolios compound into life-changing wealth. This is the analysis paralysis trap that keeps most people broke, and today, we're breaking free from it forever. Here's what the millionaires understand that everyone else misses. Less is more isn't just a cute saying, it's the foundation of real wealth building. Think about it this way: when you have 15 different funds, you're not diversified, you're diluted. Each additional ETF adds complexity without adding meaningful returns. The wealthy focus on broad market exposure because they know something crucial. You don't need to predict which sector will outperform, you just need to own the entire engine of economic growth. This is why broad market ETFs are so powerful. They hold diversified baskets of stocks from various industries, sectors, and market caps, spreading your risk across the entire economy. Take the S&P 500 for example. This index has weathered every storm imaginable, from the Great Depression to the 2008 financial crisis to the pandemic, and it has consistently delivered solid returns over the long term. When one sector struggles, others pick up the slack, and over time, this balance creates steady, reliable wealth building that beats trying to time the market or pick winning sectors. Now let me show you the first strategy that's creating millionaires while others struggle with complicated portfolios. I call this the growth accelerator, and imagine your portfolio as a rocket ship. You need a solid foundation to launch from, but you also need powerful engines to propel you toward wealth. That's exactly what this combination provides. Your foundation is 70% in VOO, Vanguard's S&P 500 ETF, which holds 506 of America's largest and most successful companies. This gives you exposure to everything from Apple and Microsoft to Johnson & Johnson and Berkshire Hathaway. But here's where it gets exciting. The remaining 30% goes into SCHG, the Schwab U.S. Large Cap Growth ETF, and this is your wealth accelerator. Growth ETFs like SCHG focus on companies that are rapidly expanding their revenues and growing their businesses at an above-average rate. These are primarily technology companies, communication giants, healthcare innovators, and consumer discretionary leaders. Companies that aren't just surviving, they're thriving and transforming entire industries. When you look at the performance comparison, SCHG has delivered significantly higher returns than VOO over the past several years. You're not just investing, you're betting on America's innovation engine, the companies that are shaping the future and getting paid handsomely for it. But let's be honest about what you're signing up for. There is an overlap between these funds. SCHG and VOO share about 53% overlap by weight, with around 122 of the same holdings. This means you're doubling down on those big tech companies and market leaders. While this has been incredibly profitable, it also means you'll experience more volatility. When tech stocks have a rough day, your portfolio will feel it more than a simple broad market approach. But here's the thing: if you have a long-time horizon and can handle the ups and downs, this strategy has the potential to significantly outperform a basic market approach. You can also modify this foundation by using VTI instead of VOOO if you want exposure to all 3,608 stocks in the US market, or VT if you want both US and international exposure with 9,809 total holdings. The second strategy is what I call the income empire, and this one answers a question I get all the time. What if your portfolio paid you while you sleep? This combination focuses on building a stream of dividend income while still participating in market growth. Your foundation remains 75% in VOO for broad market exposure, but now 25% goes into SCHD, the Schwab US Dividend Equity ETF. This fund holds 103 high-quality companies that not only pay dividends but have a strong track record of growing those dividends over time. We're talking about a current dividend yield of 3.93%. Here's what makes dividend investing so powerful. These aren't speculative growth companies. They're mature, established businesses with stable cash flows and strong financials. Companies that have been around for decades and have proven they can generate consistent profits in good times and bad. When you own dividend-paying stocks, you're essentially becoming a business partner with some of America's most successful companies, and they're sharing their profits with you every quarter. The beauty of this strategy is that it's much less volatile than pure growth investing. Dividend companies tend to be more stable because their business models are proven and their customer bases are established. What's really exciting about this combination is the diversification benefit. Unlike the growth strategy where you had 53% overlap, VOO and SCHD only overlap by 8%. This means you're getting true diversification, not just concentration in the same big tech names. SCHD focuses more on value stocks and dividend-paying companies that complement the broader market exposure of VOO perfectly. You're building a portfolio that can weather different market conditions while paying you income along the way. The allocation strategy here should match your life stage. If you're in your 20s or 30s and focused on growth, you might start with 80 to 90% in VOO and only 10 to 20% in SCHD, then gradually increase your dividend allocation as you get closer to retirement. If you're in your 40s or 50s and want more stability and income, you could flip this to 40% VOO and 60% SCHD. Your portfolio should evolve as your life does. The income reality is compelling too. Even VOO pays dividends, typically yielding around 1.2 to 1.8%, so your combined portfolio could be generating meaningful income while still growing your wealth. You have other excellent dividend options too, like DGRO, the iShares Core Dividend Growth ETF with 416 stocks and a 2.21% yield, or VYM. Vanguard's High Dividend Yield ETF with 590 stocks and a 2.83% yield. The third strategy is my personal favorite for younger investors, and I call it the David and Goliath play. This is about pairing small companies with massive potential alongside large, stable market leaders. Small cap companies are defined as having market values between $250 million and $2 billion. These are businesses that are still growing rapidly and have enormous room for expansion compared to the mega-cap stocks that dominate the S&P 500. Here's the setup. 85% of your portfolio goes into VOO for that stable broad market foundation, but 15% goes into AVUV, the Avanti's US Small Cap Value ETF. What makes this combination absolutely perfect is that there's 0% overlap between these funds. VOO holds the largest 500 companies in America, so there are no small caps in this ETF at all. By adding AVUV, you're filling in the gaps and getting exposure to a completely different segment of the market that has historically outperformed large caps over long time periods. Small cap stocks can provide much bigger returns than large cap stocks because these companies have more room to grow. A small company can double or triple in size much easier than Apple or Microsoft can. But with that potential comes significantly more volatility. Small caps can go down just as fast as they go up, and during market downturns, they typically get hit harder than large cap stocks. That's why I recommend a smaller allocation here. Nothing crazy like a 50-50 split, but enough to make a meaningful difference in your long-term returns. Even if you were using VTI, the total U.S. stock market fund with 3,608 holdings, the percentage allocated to small caps is still extremely small, so adding a dedicated small cap fund like AVUV can really boost your exposure to this high-potential segment. You have other solid small cap options too, like IJR, IWM, or VB, depending on your broker and preferences. Now let's talk about how to choose the right strategy for your situation, because this decision could make or break your financial future. If you're in your 20s or 30s with a long time horizon and can handle volatility, the Growth Accelerator with VOO and SCHG could maximize your wealth building potential. You have decades for compounding to work its magic, and you can ride out the inevitable ups and downs that come with growth investing. If you're in your 40s or 50s and want a balance of growth and income, the Income Empire with VOO and SCHD provides stability while still building wealth. You get the peace of mind that comes with dividend income, plus the growth potential of the broader market. And if you're at any age but want to maximize diversification and long-term growth potential, the David and Goliath strategy with VOO and AVUV gives you exposure to the entire spectrum of American business. Here are the 3 questions you need to ask yourself. First, how much volatility can you stomach? If market swings keep you up at night, stick with the dividend strategy. If you can handle the roller coaster, consider the growth or small cap approaches. Second, do you need income now or later? If you want cash flow today, dividends are your friend. If you can reinvest everything for decades, pure growth might be better. Third, how long until you need this money? The longer your timeline, the more aggressive you can be with growth strategies. Here's what separates the wealthy from the wishful thinkers, and this is crucial. Successful investors pick one strategy and stick with it. They don't try to mix all 3 approaches or constantly jump between strategies based on market news. They understand that consistency beats perfection every single time. The compound interest time bomb is already ticking, and every day you delay is a day of potential growth lost forever. But I need to give you one important warning, because no portfolio is perfect, and understanding the trade-offs is crucial to your success. The growth strategy will be more volatile but has higher return potential. The dividend strategy provides income and stability, but may not outperform pure market returns. The small cap strategy offers diversification and growth potential, but comes with additional risk. The key is choosing the approach that matches your goals, timeline, and risk tolerance, then having the discipline to stick with it through all market conditions. Your journey to wealth starts with a single decision, and that decision is to keep things simple. While others are complicating their way to mediocrity, you now have 3 proven strategies that have created real wealth for real people. Pick the one that fits your situation, start investing consistently, and let time and compounding do the heavy lifting. If this video helped clarify your investment strategy, hit that like button and subscribe for more wealth-building secrets that actually work. Your future millionaire self will thank you for watching today. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions.